The major theme of this week's video: what can we learn from asset class behavior? To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right hand corner of your video player. In last week's video, we compared 2016 to a bearish case and a bullish case. The million-dollar question is, after a 1.32% gain in the NYSE composite over the last 5 trading sessions, did it negate that analysis? From a fib perspective, the retracement that we have right here still falls into the normal retracement zone. The odds of good things happening longer term will improve if price can move into this area here. S&P 500 closed over 2060 this week, and as we noted a few weeks ago, we thought that the math and the model would start to show improvement at a more rapid pace above 2060, and that has started to happen. So we're seeing some improvement in terms of the data and the model, and we're also seeing some improvement on the charts that will assist us with that important, flexible, and open mind. Here's one example as of Friday, April 1st. This weekly downward sloping trend line, we closed below it last week. Now we're back above it. It's a small piece of evidence, but it is bullish, and it does help us keep an open mind. Going back to our example from last week, another piece of evidence or example, hypothetical example of improvement. This is the 30-week moving average in blue, and you can see it is starting to turn back up. This is an updated version of a daily chart of the S&P 500 as of a close on Friday, April 1st. You can see price on a closing basis came up into this area here. Is there anything else that we can learn as price is moving off of this low? Well, you might expect with the rally making a new high off of this low and with 2 pieces of good economic data that most stocks would have gone up on Friday during the rally. That's not the case. NYSE, these are NYSE numbers, Friday's session, 50% of the stocks declined, 46% participated in this move. A fair question might be, are we the only ones that are concerned or seeing things to be concerned about? I think the volume numbers answer the question for us. This is SPY volume. These are dates here. So this is volume around the beginning of the year, January 4th to January 20th, roughly. So during the decline, look at these high volume figures. These are daily trading volumes on SPY. And as we get up higher here, is enthusiasm for the rally increasing or decreasing? From a volume perspective, it's fair to say it has decreased significantly. Look at these volume figures as we move higher and higher here. There are numerous ways you could possibly explain this. I think the simplest hypothesis is large institutions were sellers here, enthusiastic sellers, and a lot of them have not bought back in. It's that simple. If the institutions were piling back in at these levels here, the volume figures would be much, much higher. Is it possible that the hedge funds and the institutions are wrong? Absolutely, positively, yes. It is possible, but there's a reason. They have reasons why they're not buying back in. We have reasons why we're not buying back in, and we fit that anecdotal profile. We were sellers here. We have not bought back in, so our volume is on this side, and it's not included here. How about the model? If you watch these videos or you're a client, you know we have a defensive type posture. You would expect, as we're moving to a new rally high, that this would have been a horrible week to hold defensive assets or more conservative assets. How did the ETFs held by the model perform as stocks moved higher? Thankfully, the answer is quite well. The average gain of the holdings in the model, they were up over 1% this week. What does that tell us? It tells us that demand for defensive-oriented assets was strong over the last 5 trading sessions, and typically that's not what you see during a rally. Typically when the S&P 500 is up 1% plus, your defensive assets would be down heavy for the week. Not the case here. All anecdotal evidence, but it does tell us something about some of the feelings behind this rally relative to conviction of buyers and sellers. Before we move to the main topic of the video, which is asset class behavior, let's point out some positive things that happened on Friday's session. This is a good-looking candle right here. There's no two ways about it. The candle on Friday is attractive relative to the last two candles, and it tells us that we should be open to more upside. This is the angle off of this low, and these lines here are the exact same angle. It's not unusual. This angle here is the identical angle to this angle here at the top, telling us that these are areas of possible resistance. As we noted in last week's video, we said this line was not nearly as relevant as this line up here for two reasons. One, price touches this line multiple times, and more importantly, we're drawing this off of a low. You really need to go all the way back up to the prior high, telling us that this area in here is definitely still in play. We also closed above the downward sloping pink trend line that was broken this week, and we were able to maintain this gap. All of this is telling us from a short-term perspective to keep an open mind. However, you can see a similar candle here, indecisive candles here back in February. We get a nice looking strong candle with a long tail, and we do rally for a few more days, but then we drop after that and give it all back. Purely anecdotal, decent looking candle is the moral of the story. Is there anything else that aligns with the theory that we could be getting ready to top here, or that the market could reverse relatively soon, at least from a probability perspective? The daily DeMark counts are also pointing toward the probability of trend exhaustion. DeMark charts and indicators are proprietary tools from Market Studies, LLC. We'll go through this very, very quickly. DeMark counts, basically a 9 paired with a 13 can tell us that a trend may be exhausted and ready to reverse, at least from a probability perspective. It works in both directions. A 9 paired with a 13, bad things happen after. A 9 in the other direction paired with a 13, and good things happen. And here, this is the low on February 11th. We now have a 913 count in this direction. There are 4 major counts. Not all of them are on a 913, but they're close. So it aligns with, we could possibly top here with this 9 and 13, or we could push higher for a few more days and top with one of the other 9 and 13s. Can't emphasize enough, like anything else, this speaks only to probabilities, and we can learn something either way, because if this 9 and 13 is negated, it tells us that we have a strong trend and we're probably going to go higher. After this slide, we'll move at a more rapid pace because the concepts are similar across all of these charts. You can pause the video down here if you want to examine them a little bit more closely. 2009, this is a risk-on, risk-off chart. Used by the model, we're looking at consumer discretionary divided by more defensive consumer staples. This is 50 days after the low in March of 2009. Why do we pick 50 days? Because we're 50 calendar days removed from the February 11, 2016 low, so we're comparing apples to apples from a timing perspective. Point number 1, the ratio bottoms before the stock market. Point number 2, we make a higher low followed by a higher high, and look at the conviction of this move when stocks bottom in early March of 2009. And the other thing that's important is we clearly take out these previous rally highs from the previous months 50 days after the low. Prices above both moving averages. These are just arbitrary moving averages. These pairs are not used by the model, using them for illustrative purposes only. Full bore bullish look 50 days after the low. How does the same ratio look today? And more importantly, what is it telling us about the improvement in risk tolerance 50 days after the low. Before we compare the two periods, a fair question may be, why are you comparing these two periods? We're comparing these two periods. This helps us understand concepts. We can X this out. We don't need to look at any of these charts over here. It doesn't change what we're seeing on this chart here. This chart here has no relevance to this chart here other than it helps us understand and gives us a reference point. This chart in 2016 says what it says regardless of whether we're comparing it to anything. Remember here, one of the key elements was clearing the previous high. Here's the high now. Here's the previous high here. We are not even in striking distance of taking out the November-December high on this ratio. We don't have a bullish moving average crossover, and this looks fairly tepid here. This chart is improving point to point. This one has a slope that's still down, and it says a lot about confidence relative to this move off the low. In this case, you may say, well, the Fed, we're in a different interest rate cycle here, and that may be a fair point, but you have to ask yourself, why are we in a different interest rate period, and why is the Fed talking about holding off on raising rates? That tells us something about the current state of the 2016 economy. Here's 50 days after the low, defensive TLT. The S&P 500 bottoms right here. You can see months before TLT starts to sell off, and it's about to move to a full-bore bearish look, and 50 days after the low, it makes a lower low, and now it's making a series of lower highs and lower lows. The moving averages have rolled over. This is fear here, and this is where fear starts to wane. How does the same chart look 50 days after the current low? Quite a bit better. And if I owned TLT and I was looking at this daily chart, and it's making a series of higher highs and higher lows, and our moving averages look like this with the faster moving average on top and the slower moving average on the bottom, I would be in no gigantic rush to sell this. We just went back and we tested the 50, and we're moving back up. As it stands now, this chart still looks pretty good. You can make an argument that this period here is similar to this period here. That may be the case, but this is a much more shallow move, and duration is shorter than this move here. This also takes place well above the 50 and the 60-day moving average here, which is not what we have here. This is still a healthy looking chart, and one of the things that we have in our favor when we put these type of investments, defensive investments, through the ETF scoring system, the ETF scoring system rules are saying we are not allowed to sell them based on that piece of the model. Why? The trends are still too strong, telling us something about the tolerance for risk here in 2016 relative to the change in the tolerance for risk 50 days after the low in 2009. Same concepts here in the credit markets, but we're getting a relative look now, which means we're somewhat filtering out the interest rate piece of it because both of these ETFs are interest rate sensitive. This is a diversified basket of bonds, AGG, relative to more defensive treasuries. This includes all different types of bonds from a rating perspective, including lower rated and higher yielding bonds. So this is a risk on versus risk off credit ratio. And as you might imagine, it bottomed well before the stock market bottomed in March of 2009. And it also went on 50 days after the low here and printed a clear higher high above these levels here. And look at the slope of that. We've got price above both moving averages, and blue is about to retake red. We're very, very close 50 days after the low to a full bore bullish look. But the more important thing is the conviction, the slope of this, and the slope of this. So are we seeing similar slopes here, and have we broken a trend line as we did right here? And have we made, after the break of the trend line, a higher low followed by a higher high? This is step 3 for a bullish trend change 50 days after the low. The other thing to think about before we move to the next chart, this is what I'm concerned about defaults looks like. This is what I'm less concerned about defaults looks like. In the present day, when we've moved off the February low, we are not even in striking distance of making a higher high in this ratio above the November 2015 high. We're clearly still in a downtrend with a full-bore bearish look 50 days after the low. And instead of having a conviction move in here, we have just the opposite. This ratio peaked several weeks ago and has started to fall again near the moving averages. And in fact, it was down again on Friday at 1:46 p.m. Same exact concepts, and it doesn't matter about the maturity mismatch because we are comparing apples to apples. We'll get a similar result if we plug in IEF. Here, we're looking at risk off versus a confident credit ETF. We can learn a lot from this. You can see confidence about the future and a lower probability of default starts to show up in the charts literally months before the S&P 500 bottoms here. Full bore bullish look and a higher high. This is what I'm concerned about defaults looks like. This is what I'm less concerned about defaults looks like, this slope here. And this is, I'd rather chase yield because I believe I will get my principal back. Does the present day look more like this or this 50 days after the February low? The conclusion is similar to the previous chart. This rally high here in the ratio is not even in striking distance of making a higher high after several weeks of rallying off the low. And maybe more importantly, if you believe that credit leads the stock market, this ratio has now been falling for several weeks. Just looking at another defensive bond ETF in isolation, you can see a switch over here well before the stock market bottoms. Present day chart using these moving averages has a full bore bullish look and a relatively steep slope and confident slope about bonds as of April 1st. Let's look at it from an opportunity cost perspective. You can see SPY, risk on relative to risk off, bottoms in the same period as the stock market and has a confident move here the entire time from this low to 50 days after the low. We'd like to see somewhat of a confident turn like this. We'd also like to see a higher high. If we remove the dates and the labels from this chart and just looked at this, and we were taking a technical analysis multiple choice test and it said, is this an uptrend or a downtrend? We would say that is an easy answer. It's a downtrend. We have a series of lower highs and a series of lower lows, and thus far the S&P 500 is up in striking distance of these areas here, and several stock indices are, but this chart isn't aligning. We're nowhere near taking out this November high yet, and this move here really doesn't look any different right now than this move here, other than mathematically it is weaker. Look how much improvement that we get here. Now that the trends are rolling over, we have much less mathematical improvement, and we also have kind of a rolling over look here. Could this ratio improve? Absolutely, positively, yes. But there's no debate that this currently is a downtrend, and it tells us from an odds perspective, bonds are trending in a bullish manner relative to stocks on this time frame. A little different flavor, consumer discretionary. I'm confident about the future stocks relative to I'd prefer to be defensive bonds. Stock market bottoms here. Look at the slope. The ratio moves from somewhere around 0.17 in 50 days all the way up to almost 0.26. That's a big move, an improvement in terms of the look of this chart here. This looks a lot better than this over here. We want the present day to look like this, and we'd prefer to see some type of discernible higher high relative to some previous highs. As of Friday, April 1st, we do have improvement here, but not anything like this, and we're nowhere near, not even in striking distance of making a higher high yet. That may happen, but this is a relatively weak move given the move in the stock market. It's a weak move in this ratio here. Common economic sense tells us that if we're confident about future economic outcomes, we would rather own economically sensitive XLY type stocks rather than the stoic S&P 500 or SPY. And you can see here this ratio. Look at the conviction, economic conviction, 50 days after the low here. The ratio bottoms before the S&P 500, which bottoms here. And this is an extremely things are better now than they were before type look, taking out these highs, these highs, these highs. In fact, it makes a brand new 1-year high on this chart 50 days after the low. In the present day, we do get a confident look off the low. The problem with it is this has now been making a series of lower highs for over a month as the S&P 500 has continued to rise. We are relatively close to taking out these highs, but we're nowhere near taking out the highs from the previous rally high in the S&P 500. And I can draw a trend line down here that still seems to be bounding price right now. Blue above red 50 days after the low, blue below red 50 days after the low. Some improvement, but not very impressive relative to this type of conviction about future economic outcomes. Let's fly through some open mind charts. Some of them will be negative, some of them will be positive. This one speaks for itself. Lower high, lower low in the 50, 200-day rolling over. Same concepts, 200-day in red, 50 in blue. This is the Dow after the big rally. This is as of Friday, April 1st. Glass half full helps us keep an open mind. We have a breakout here, a retest here, telling us we could move to these lines here next. It's definitely within the realm of possibility. Glass half empty, trend in the S&P 500's 200-day moving average as of April 1st. We've gone from a bullish primary trend with the 21-day having counter trend rallies to a bearish primary trend with the 21-day having counter trend rallies. Is this subject to change? Yes, it is, but it has not changed yet. This chart has both elements. Glass half full, white space above. This is a good looking candlestick. If I were looking at a candlestick, glass half empty. All of these lines above still slope downward as potential resistance. S&P 500 weekly, glass half full, especially in the short term. Potential resistance, hot knife through butter. We could move up here closer to 2100, and this still has a downward slope to it. A daily version paints the exact same mixed picture. This red slope here matches this slope here. This is a good looking candle telling us there's still some white space here heading into next week. VIX daily, also a mixed bag. This is declining fear here, which is typically good for stocks. Support, support, potential support. Anecdotal evidence, S&P 500 stalled after that point. S&P 500 stalled after this point here. We learned something either way. It's a daily chart of oil, a trend line drawn weeks ago, bullish breakout. Now we've given it back. An anecdotal observation here, RSI plunges below 50. After that, bad things happen. RSI tanks as it drops below 50. After that, bad things happen. This is a plunge here, and we drop below 50. Glass half full. RSI has held in this area before. Oil weekly here. These are closing prices. We haven't made anything in terms of an important higher high. and there's some white space down here that might want to be filled, possibly by the market. Emerging markets daily, we learn something either way relative to what happens near this line. The same concepts apply to XLB materials daily. Transportation average, IYT weekly, here's our A, here's our B. We're right in the middle of the normal retracement fib zone. We had a bullish breakout above this line last week, and it looks like we've given it back. Some historical perspective, S&P 500, big decline here. We get a bottom, we rally for 70 calendar days to May 19th. What happened next? The counter trend rally ended on May 19th, and after that, the S&P 500 lost an additional 53%. That's not a prediction about the present day, just making a point about how long counter trend rallies can last. If you're wondering, are we over 70 days today? Not even close. The current rally is at day 50. Energy stocks as of the close on Friday, April 1st, remain in a primary downtrend until proven otherwise. The last thing XLE did was make an important lower low. It has not made an important higher high of any kind yet. High beta or economically sensitive stocks as of Friday, April 1st, we have not made anything close to an important higher high yet. And if we take this and we take high beta stocks and divide it by low beta stocks, we would expect this to get a boost during a rally, meaning this high here should be closer to this high here if we divide it by defensive stocks. It's just the opposite. Instead of getting a boost, the rally here has not moved into this area. This is a lower retracement on a relative basis here, and it also should be noted that this ratio has been dropping since March 7th. I would consider this to be a glass half full, and we better keep an open mind chart. An equal weighted S&P 500 is very close to exceeding these highs from the previous rally. These markets continue to be frustrating for our time frame, but we know if we continue to execute, typically you're going to get a big move after you go sideways for 784 calendar days, as we did from the low to this point here. The longer you move sideways, the bigger the move that you get. It could be up or down. If we execute, we should participate. What changed? Why did the market rally so strongly here? Obviously, there are an infinite number of answers. We've said there's nothing more important than central banks. When the stock market is falling here, the Fed is signaling that they're going to raise rates 4 times this year. Then, as things start to get ugly, they cut it not from 4 to 3, they cut it all the way down to 2. And earlier this week, Yellen basically moved from 4 rate hikes to we're not really sure if we'll ever hike rates again. Then later in the week, Evans from the Fed, the day after, came out and said, we'd rather do everything else before using negative interest rates, which is basically saying the Fed is prepared to throw everything at these markets, and if they're going to go down, they're going to go down swinging. This is something that we need to respect. Also, OPEC stepped in with a statement literally here, and the market reversed. How meaningful is that? We want to give credit where credit is due. These wonderful charts come from this website. There's an excellent PDF about oil. If you Google this name here and things about oil, I'm confident you can find that PDF. This is crude oil output, millions of barrels a day. This is OPEC output, and this is non-OPEC output. 2 different sources of information. Moral of the story: it is disingenuous to say an output freeze would change things. Why? They're talking about freezing oil output at basically record levels. From Bloomberg, for Saudi Arabia to announce an output freeze is disingenuous when their production levels are already at a high water mark. That quote was from a few weeks ago. This quote was published by Reuters on Friday, April 1st. Even if a pact is signed, it would have little impact on supplies because most of the countries involved have little capacity to increase output even if they chose to. If they sign a pact, it doesn't change balances one bit. They're talking about capping production levels near all-time highs. While there are countless drivers for the rally here, we do know that OPEC and the Fed and central banks around the world played a large role. Earnings expectations probably did not play a role. From FactSet, two things. Negative earnings per share guidance for Q1 approaches a 10-year record. That's negative guidance. And as of Friday, they tweeted this from their Twitter account. The estimated earnings decline for the S&P 500 in Q1 is a drop of 8.5%. So if OPEC and the Fed helped boost markets, a fair question would be, if earnings are falling, what would that have done possibly to valuations? FactSet March 26 tweeted the forward PE ratio, the current forward PE ratio for the S&P 500. Here are valuations here peaking as the stock market peaks in 2007. So a fair question would be, if valuations peaked at this level here, how do we compare today in 2016 after OPEC and the Fed have helped push prices back up? The answer is the forward PE or valuations are actually higher today, meaning they are less attractive or worse than they were when they peaked before the financial crisis. It should be noted, it is possible. There are periods in history where you get something like this, where earnings estimates decline, and that happens near a low. How is that possible? Well, expectations for earnings that are due to be released here starting in earnest in mid-April, expectations are incredibly low. So we have to keep an open mind that earnings could exceed incredibly low expectations and change everything that we have here, and it's possible that the market would then get more of a bullish bent. However, that's a forecast. We need to see that change, but it's important that we're open to it and we understand sometimes a number like this can be bullish. This type of movement is incredibly frustrating. However, we have to keep in mind that defensive assets can go from maddening to incredibly satisfying and picking up steam very, very rapidly. Maddening to incredibly satisfying very rapidly. That's not a prediction, but we can see from looking at this chart, our upside is probably somewhere between where we are now and 2120. Our downside, possibly with this type of a look, is back below 1800. As always, the key to success is consistent execution. Given that the model has started to improve at a more rapid rate, and we've seen some improvement on some of the charts that we covered in this week's video, it's incredibly important that we head into next week and the weeks that follow with maximum flexibility, which requires an open mind about all outcomes. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.